Saurabh Mukherjea joins in with his market perspective as well from Ambit Capital. Saurabh, good to have you on the show. How are you looking at the market at this point? Are you also believing that the market would continue to be in a range unless some key trigger either on the macro side or globally will push the market higher from here?
So 3 weeks ago in our latest Good and Clean portfolio, we cut the weightage of industrials and construction. That was the first decisive weight cut we've taken in industrials and construction in over 12 months. And we increased the weightage for FMCG and IT for the first time in 12 months. We're still overweight cyclicals. We're still overweight sectors like auto ancillaries. But overall, my sense is that the going is getting difficult for cyclicals, both from a valuation perspective. If you look at the price to book of cyclicals to defensives, we are close to the long-term average now after a good 12 months of rally in cyclical stocks. And also, I think the going is getting very difficult on the reform front. We really are not seeing meaningful movement on the reform front either in the power or the banking sectors. So I don't lose that much sleep about results such as BHL or the IIP data. I think what's worrying us more is that there really does seem to be very little happening in Delhi by way of meaningful reform in the power and banking sector, and that's making us much more circumspect about industrials, about construction, about the heavy manufacturing sector than we have been for say a good 12-15 months.
Saurabh, some would argue that it's only been 60 days, and 60 days is a short time for anyone to do something big or special.
Yeah, I don't think anyone was expecting miracles. What we were expecting was some sort of plan of action on the three key issues facing the Indian economy, and these issues are well known. One is our structural challenge with food inflation, which has been given an impetus by the subpar monsoon, but the food inflation challenge has been with us for at least 3-4 years now. We're expecting to hear some sort of plan of action from the new government around it. We haven't heard any as yet. Second was the problems which bedevil our power sector. Lack of coal, where thankfully there seems to be some movement on the coal front, PPA prices which are too low, and discoms which don't have any money. Again, we're not seeing much movement on the discom front or on the PPA repricing front. And the final issue was the state of the banking sector. PSU banks account for 72% of credit. They have weak tier 1 ratios. They're barely lending. Credit growth is barely 11-12% from the PSU banks. We were hoping to hear as to how these banks will be recapitalized. We're still waiting to hear that. So I don't think we were expecting cement hitting the ground, so to speak, or concrete hitting the ground by August, September. So we were waiting for some clarity of thought from the new administration. We haven't seen that. Hopefully by November, December, we will see some policy movement on these three key issues: food, power and banking.
Saurabh, I'm going to frame a question and throw that at you. Bhushan Steel, that bribery issue in Syndicate Bank, are these telltale signs and clear examples that PSU banks are nowhere close to the earnings bottom and the corporate governance standard, irrespective of the government intervention and government action, is slightly inadequate?
I think on corporate governance standards, I think you put it fairly mildly. To say corporate governance standards are slightly inadequate, I think is to put it very politely. My sense is that across all PSUs, not just PSU banks, I think even across say Coal India, ONGC, the broader oil PSUs, the metals mining PSUs, I think there will be a serious tightening of corporate governance standards by the new administration. It will probably take 2 to 3 years, but I would expect some major changes in terms of the way PSUs are run in our country. I don't think privatization is happening. I don't think the NDA has the appetite for privatization, but I do think we will see a major tightening in the way PSUs are run. On the question of PSU banks' earnings, I don't think EPS will degrow this point, profits will degrow this point. What I think will happen with the PSU banks is they simply don't have any money to lend, to put it very simply. I can't see the PSU banks sustaining credit growth more than 11-12% unless the government comes up with a clear plan as to how these banks will be recapitalized. Most of their tier 1 ratios are 6, 7, 8%, and that means that necessarily they have to lend at at 10, 11, 12% to hold on to those tier 1 ratios. That's clearly not going to be enough to take growth even near 6%. Forget about getting to the heady levels of 6.5% that some people are expecting for FY16. I think that's a key challenge for the country. You have the bulk of the banking system with balance sheets in a terrible mess. Until you fix that, there's not going to be credit growth, which will take the country to even close to 6% growth.
So what's the position that you're taking on banks right now, especially the PSU banks?
So banking as a sector, we've been underweight, and PSU banks have been sellers of all of them, bar Bank of Baroda. Bank of Baroda is the one PSU bank where we believe asset quality is reasonable, the liability franchise is reasonably good, and it still trades at a 20% discount to SBI. So PSU banks, I don't think it's a pretty story overall. If you had to choose one, I would go for Bob. But banking as a whole, I think as a sector, we struggle to see where the optimism that is baked into stock prices will come through. And I think much the same applies to sectors such as boiler turbine generators. So the run-up in stocks like BHEL, like Crompton Greaves, like the T&D companies, it's left us somewhat perplexed, given that the underlying economy still is only in the early stages of recovery, and policies is almost as hobbled as it was 5-6 months ago in the power and banking sectors.
Just as we speak, Saurabh, finance ministry sources saying Bhushan Steel may be termed as a willful defaulter. I think the total amount that Bhushan Steel owes is about 40,000 crores to banks. Banking department reviewing top 50 NPAs of PSU banks and will take necessary steps to recover loans. So clearly, all of the PSU lot are under the scanner. The bank consortium to meet on August 18 to take a call on the Bhushan Steel loan. Banks have total exposure of about 40,000 crores to Bhushan Steel. Would this also put the whole deleveraging story into focus? Because people have been on the fund management side, and also in terms of selling ideas to clients. They've been talking about how a lot of companies have been deleveraging, have been reducing their debt. Some of them may be sitting on too much debt, and so much that there's not enough to liquidate through asset sales as well. Does this put a question mark on the deleveraging story, or do you think that if these companies are able to bring down their overall debt burden, they could look attractive?
I think that was a story which did the rounds in the initial month after the elections, wasn't it? In the initial months after the election, the hope was that there'll be a whole spate of asset sales by companies with distressed balance sheets, and after selling assets and after doing a QIP, perhaps a couple of QIPs, these companies would look in decent shape again and can begin life. I'm not so sure that journey is as easy as it was made out to be when those QIPs were taking place in late June, early July. My sense is that for the asset sales to happen, in the vast majority of cases, for power plant asset sales or for road asset sales to happen, I think the banks will have to take a haircut on their loans. If the banks don't take a haircut on their loans, there simply isn't enough cash flow associated with these power plants or roads for a new equity owner to come and take an interest in these assets. So I think the needle will, the owners will once again switch back on the banks to take a hit on their assets so that the equity sale can go through. Because of their weak tier 1 positions, I don't see the PSU banks being in a position to take those hits on their assets. And once again, I think the whole deleveraging story will get constricted. The deleveraging story will get held back because of the weakness of PSU balance sheets.
Well, Engineers India has taken a knock of about 11%. They've come out with poor set of numbers, and in this market, if you don't deliver, there's no space for you to hide. The other one is BEML. They've reported a loss. Yes, they've reported a loss for the quarter gone by, and the stock reaction, the stock is circuit down 587 rupees for BEML. Saurabh, some of the mid-tier PSU high flyers are getting grounded. Do you think there is a certain realization which has kicked in that nothing will change in the short term, because immediately after elections these stocks just went berserk and now some reality check has kicked in? I
think clearly as the honeymoon period gradually draws to close for the NDA government. Reality checks on all fronts are kicking in, whether it be the banking sector or the broader PSU sector. That being said, actually, I think there are some plays in the PSU sector which I think do genuinely represent structural opportunities. I think on the coal front, the government is actually doing fairly meaningful work. Coal India's production numbers show that. Our discussions with mining managers also suggest that there's a fair bit of urgency that's been injected into Coal India. Similarly, the Indian Railways team, which is building new railway lines for Coal India, is working with a far greater level of urgency than I've seen before. So I think Coal India does remain, I think, a powerful structural play on India's need for coal and the new government's ability to unlock India's coal potential. I would say ONGC, while subsidy burden worries will never quite go away, given how our country works. I think ONGC, there's a good chance that if the new gas price comes at around $5-6, ONGC will be the major beneficiary of that. Add to that the government's desire over a 2-3 year period to get fuel deregulation going. I think ONGC is potentially another structural play. But beyond that, names such as BHEL, we couldn't understand what the sheer amount of enthusiasm that BHEL generated, where it came from. It certainly didn't come from management guiding the market upwards, and I think it's but inevitable that something like BHEL will now crumple back relatively quickly.
Friends, in the market, everything and anything goes up. So I'm going to take the discussion forward, Saurabh. You like Coal India and ONGC, but the big challenge for Coal India and ONGC could be fresh government paper supply.
So in Coal India's case, they're not challenged for funds. Maybe the government will decide to disinvest a slug of Coal India as part of its privatization or part of its disinvestment plans. But Coal India's case, financial concerns are actually not the binding constraint. The binding constraint remains the ability of the government to deal with what is a giant company broken up into 3 or 4 mega subsidiaries. Can the government really push from the top down, from the coal secretary downwards, and get production growth towards, say, 8, 9, 10%? My sense is the answer is yes, because the key bottleneck for Coal India was railway lines. That's a problem that's being addressed for the first time in 8, 9 years. So in Jharkhand, Chhattisgarh and Odisha, we're finally seeing some movement on those critical railway lines. ONGC's case, yes, there is a balance sheet challenge, but that balance sheet challenge can be addressed relatively quickly with clarity from the government on how much of the subsidy load ONGC will take. Diesel deregulation continues. My hope is after these 4 state elections, we will see some movement on the LNG front, some reform on the LNG front. And if kerosene moves to direct benefit transfer next year, I think that will be a pretty decisive step forward for ONGC. There will be a decisive reduction in the subsidy burden and a big step forward for ONGC's balance sheet.
Saurabh, I just want to mark a few stocks. Voltas, these are price and volume breakouts that we are seeing. Third day of gains above the 50-day moving average. There's also Hindustan Unilever that I've been tracking very closely of late. It rises for the second day, and you're seeing the stock at 705. Good price and volume participation there as well. And Shriram Transport up for the third day at the 50-day moving average. Any one of these 3, Saurabh, that you like are recommending, especially HUL above 700?
Not really. I mean, in all of these 3 companies, I think there are reasons to be cautious. In HUL's case, the valuations are completely out of sync with the very modest earnings growth prospects of the company. This is a company which will barely generate double-digit earnings growth over the next 2 to 3 years, and yet the earnings multiples are considerably north of 30 times. In Shriram Transport's case, my reading of the situation is that the RBI is pretty clear that if you're a large NBFC and you're competing head-to-head with the banks, the RBI wants you to become a bank. I think Raghuram Rajan's thinking on this subject is becoming clearer and clearer by the passing month, and hence I think it's inevitable that in the next 6-7 months the large NBFCs, not just Shriram but others as well, will move towards the wholesale banking license, and that I think will have a dampening effect on its ROE. And the first stock you mentioned was Voltas, right?
Yeah, Saurabh, Voltas.
Yeah. So in Voltas' case, I think, look, it's had a nice run up. It's a company that we like. It's well managed balance sheet. The air conditioning business is a champion in its sector. The concern remains on the construction side. Is there is there enough visibility on the engineering side of the business, the MEP side as they call it, mechanical, electrical and plumbing side of the business? Is there enough visibility on the order book? I think the answer is no, and hence on risk reward basis I would stay away from that as well. Where I would look with great deal of interest and enthusiasm is promising small caps. So Balkrishna Industries, which is exporting off-highway tires to America, I think is still very attractively priced. I would say 20 to 30% upside in that over a 12-month horizon looks realistic to me. Good company, well run, recovery in the West should help the company. I would continue to look at TVS Motors. This is a stock we've been advocating for the last 18 months. I think TVS Motors will continue to gain market share, and again 20-30% upside over a 12-month period looks realistic. Shobha Developers down south. My sense is that the real estate cycle will turn over the next 6 to 12 months. As it is through the downturn, Shobha did very well. With its good balance sheet, the largest land bank in South India, Shobha I think is well placed to benefit from the recovery cycle in real estate that should kick in towards the end of this fiscal.
We touched upon this earlier as well, but I just want to mark in, the Telangana government issuing orders for waiving farm loans, and the impact that would have on stocks such as Andhra Bank, SBI, already given the NP concern there.
Yeah, I suppose we'll as long as we are a democracy, politics and politicians will be part and parcel of stock market life, and it concerns exactly like this, which makes PSU Bank such a difficult buy. I know SBI has doubled in the last 9 or 10 months, but I still find it difficult to ask anybody to buy the stock exactly because of concerns such as this.